Good morning, ladies and gentlemen. My name's Scarlett, and today we're going to be discussing the ways in which adoption of the ASX corporate governance principles and recommendations influences the auditor. So what is corporate governance? Well, it's the collection of mechanisms, processes and relations by which corporations are controlled and operated. It's about good decisions being made by the right people to ensure businesses are operating ethically and successfully. So the ASX compiled a list of 8 corporate governance principles and recommendations which suggest policies and procedures a company can adopt to implement best practice. And you can see these 8 principles here. Together, these principles collectively promote independence, professional competence, integrity and transparency to both shareholders and the company. In this presentation, we're going to discuss the ways in which adoption of these principles will influence the auditor's risk assessment process, audit approach, audit strategy and audit evidence. So we'll kick off with the risk assessment process, and you can see here the ASS 315's description of the risk assessment process. And some risks to consider that could contribute towards material misstatement include inherent risk, which could occur if no controls are in place within the company and requires judgment from the auditor regarding the industry and the company. Another risk is a control risk, and this is a risk that material misstatement may not be prevented or identified by the current internal controls in place. Although an auditor cannot change inherent risks or current control risks, they can suggest changes to improve internal controls for the future. So a recommendation is that a company adopts a risk committee and an audit committee, and these play a crucial role in impartial communication between directors and the external auditor. The primary focus of these committees is to oversee the financial accounting and reporting, discuss sensitive matters with the auditor, for example, a lack of internal controls, and the timing of the external audit work. The implementation of an audit committee will positively influence the auditor's risk assessment as areas of risk can be effectively communicated and an independent overview of the financial reporting has been implemented, lowering the risk of material misstatement. The risk of material misstatement will also be reduced through the implementation of a whistleblower policy and an anti-corruption policy as recommended. So fraudulent activities have to be considered by the auditor, which could include misstatement from fraudulent financial reporting or misappropriation of assets. By enforcing a whistleblower and an anti-corruption policy, fraudulent activities are more likely to be flagged by the audit committee, and the external auditor can effectively plan the necessary audit procedures, whether it be a test of controls or substantive procedures. In addition to this, professional competence is a major component of the ASX principles. The auditor needs to understand how management identify business risks, assess its significance and likelihood, and manage these risks. The competency of financial understanding by management is also crucial. If the auditor identifies a risk of material misstatement, they will question why this was missed with the directors.
Audit's approach involves look beyond the input and the process in places or assessing the impact and outcome of this entity. It's necessary a solid understanding of this entity, its environment, the industry, the regulation, the application of the accounting policies. Auditors need to understand the entity's objectives and strategies. Only with this full knowledgement, the auditor can assist in assessing risks or identifying areas of attention, for example. This approach needs to be efficient and have to be effective. It can include tracing transactions, internal control validation, risk review, balance sheet testing. Audit strategies express the scope, direction, and timing of these audits and provide a more comprehensive audit plan. It's important that auditors, through this knowledge of this client's operations, risks, the environment, they need to be able to make judgments. Make judgments on areas of risks, for example. The ASA 300 requires the auditors to develop and document an audit plan with a list of procedures to be followed. This strategy takes into consideration the impact of materiality, the audit risk, and the appropriateness of the audit evidence. It's important to have also a meeting with the audit committee to discuss these strategies and plans, making sure that the auditing standards and the quality control principles have been considered in their development. There are 2 different types of audit strategies to consider. The first one, the predominant substantive approach, it's used when the auditor believes there are inadequate or ineffective internal control. Otherwise, the lower assessed level of control risk approach which is to guarantee a well-designed and effective internal control.
Audit evidence is the stuff we gather as auditor to support our opinion on the fairness of presentation of the financial information prepared by management and from the other sources. It's responsibility of the directors, managers to make assertions when presenting financial reports. These assertions will be used by auditors to establish the risks. Evidences must be found for these assertions before the auditor can state the financial report. Assertions such as account balance, class of transactions, disclosures, and more made by the governance as cited before is based in competence and transparency. But auditor must be use judgment and skepticism to make more reliable. Having identified these key risks, assertions be dressing a procedures to gather the evidence that address the risks association with these assertions. So audit procedures is used as an instruction for an auditor to perform the gathered evidence. This is influenced by understanding of the entity, assessment of entity risk, materiality of financial reports, and reliability of the information. An audit committee with internal and external auditors can provide information regarding the areas of concerns and important areas of claim. This helps the auditor establish the appropriate audit procedure, test of control, or substantive test. In audit procedures can use the following types of evidence: inspection, observation, inquiry, confirmation, recalculation, reperformance, and analytical procedures. In the end with all these evidences, the auditor can more properly address the areas of possible misstatements.
We presented how the full adoption of the ASX corporate governance principles influence the company and auditors on risk assessment process, audit approach, audit strategy, and audit evidence. Based on these principles, a company can safeguard professional competence and segregation of duties, can encourage independence between board members, enforce them to perform ethically and report with integrity, ensure that the changes are reported quickly to guarantee the share price is reflecting the correct value, promote transparency and investor confidence, recommend committee and internal audit to oversee and manage risk, encourage independence and transparency regarding management pay. The adoption of these recommendations increased financial performance of the company due to the professional competence of the directors and the board and their ability to make effective business decisions and quality strategic decisions. It increases transparency and minimizes self-interest because the independence of the board committee guarantees that the opinions are expressed to reduce self-interest, especially when they are reporting, giving information to shareholders and to the organization. Also, it increases investor confidence, since the independence of auditors and the board committee ensures that the company is acting in the interest of the shareholders rather than themselves, and that the company information will be transparent and promptly available to investors to make decisions. In resume, these principles promote good corporate governance and feed the ideas of accountability, objectivity, professional competence, and integrity. It helps auditors to have confidence that the information provided will be precise and reliable, and risk will be minimized. It helps auditors to have confidence that the directors and board members have the professional capabilities to fulfill their roles, and that irregularities will be reported confidentially. Also, it provides a vital line of impartial communication to help the auditor establish an effective audit approach and strategy. Thank you.